Welcome to our class where we're going to look at final accounts. This is the climax after learning how to transfer recordings from the journals. You take them to the ledger accounts, then you post to the trial balance. Then now you want to prepare what is called the comprehensive statement and also the balance sheet. Now, before I go into the nitty-gritties, at least you need to understand that the trial balance is simply a list of balances. A trial balance is arranged using our format that we talked about. Debit looks at things, and the credit looks at the things that are as follows. We use the term payrolls to understand what is usually on the debit side and what is usually on the credit side. So before I go into the final accounts, all purchases have a debit balance. All expenses have a debit balance. All assets have a debit balance. And what has a credit balance? We have revenues or capital, all liabilities, and all sales have a what? They have a credit balance. So financial accounting is based on the principle that we debit the receiver and credit the giver. We debit the receiver and credit the what? The giver. So it is also based on what is called a duality concept. So I'll firstly look at what has already been given here. We justify why it is credited and why it is debited. So this is already a balanced trial balance. So I want you to explain to me why each of those items are debited or credited. So to start with, we have bank, which is on the debit side. Why was it debited? Anyone quickly? Why was bank debited? Because it is a what? It is
Asset.
a current asset, correct. So it is an asset. Then we go to another one. Given share capital, it is credited. Why? Because it's a revenue. Cash is debited because it is what? An asset. Long-term loan is a liability. Insurance is an expense, office expenses, already the expenses. Fittings and fixtures, the assets. Assets have a debit balance. Accumulated depreciation is credited because it reduces what? The asset of the fittings and fixtures. Provision for doubtful debts, they reduce our debtors. Purchases have a debit balance. Salaries are expenses. Sales from payrolls are on the credit side. Stock is an asset. Account payable is a creditors. And account receivable is a what? Debtors. Debtors have a debit balance. All right, together. So we are fulfilling this term that we're using called payrolls. Right. Now I'll give you a list also that I need you to help me identify whether it's debit or credit. So let's start with fittings and fixtures there. Are we just tell me it's debit or credit? So this is not balanced, so you can tell me quickly.
Credit.
Credit, fittings and fixtures, is it right? Accumulated depreciation?
Credit.
Credit. Is it right? Discount received?
It's credit because that's like income.
Yes, it's credit. It's a gain, it's a revenue. Trade receivables. So one of these that you've answered here is wrong. So you need to identify it. Trade receivables.
I think fixtures and fittings are supposed to be debited. Those are assets.
Yeah, assets, correct. So they're supposed to be debit. Okay. Trade receivables.
You debit.
Because they're debtors, yes. Carriage inwards. Debit.
Debit.
Postage, debit. Expenses, debit.
Debit.
Bad debts, debit. Returns inwards,
Credit.
credit.
Credit, yes.
Carriage outwards. Why are returns inwards credited? The other term for returns inwards are called what?
Sales return.
Sales return.
Sales returns, because sales are credited. So to reduce the sales, we need to debit. So this is supposed to be a debit. Meaning returns outwards is purchases, returns. So because they reduce the purchases, they will be credited. So this was wrong. Carriage inwards, outwards.
Debits, an expense.
An expense, yes, a debit. Drawings,
Debit.
you debit them. Why? They reduce the capital. What are drawings, by the way? What are drawings?
It's like money paid to shareholders when shareholders decide to get some money from the business.
Money paid to shareholders. Okay. Anyone else? What are drawings? These are withdrawals.
I think it's money gotten from the bank.
Money gotten from the bank. Anyone else?
It's like the money gotten from the business for like personal use, not to put back in the business.
Exactly. That is the correct definition of drawings. Did you hear what she said?
No.
Can you explain? Can you explain to them again?
So, I said it's money that is gotten from the business, but it's not intended for use within the business. It's gotten for personal use. So it's not going back to the business.
Okay. So these are withdrawals that are taken by the owner of the business for personal use. Okay. For instance, you run a cantemba and you don't have bread at home. So you decide to get a bread for personal use. So that is called a drawing. Okay. Yeah. So these drawings will reduce your capital, so we debit them. They are like an expense. They reduce your revenue. Okay, next we have rates and rent. These are expenses. We debit insurance, debit writing, debit advertising, debit cash at hand, debit. These are our assets, and these are expenses. Inventory. What do we do? Inventory. Assets, we debit them. Purchases, using periods, we debit. What discount allowed? We have discount received and discount allowed. How do you treat discount allowed?
You debit it.
Yeah, discount received was a debit. No discount allowed. A debit.
Not that discount received we credit, then discount allowed we debit.
Okay. Is she right?
Yes.
No, she's not right. Discount allowed is an expense. We are losing out. So expenses are debited. It's a selling and distribution expense. But discount received is a revenue. Facing perils. So we are being given some monies. So we are going to do what? To credit. That's why it has the discount received is supposed to be credited.
That's what I said. Yeah.
Oh, okay. It's actually credited here. Then discount allowed with debit. Oh, correct. About allowance for doubtful debts? Returns outwards? Trade payables?
Returns outwards, things supposed to be credited. That's like purchases returns.
Doubtful debts debit.
Doubtful debts, debit. And capital?
Credit.
Capital debit.
And
Returns outwards debit. Capital debit.
capital?
Capital and
Debit.
sales credit. Capital
Capital
and
debit.
sales, we credit and sales.
Sales credit. Capital debit.
No, capital and sales, they go.
They are both credited. Okay, at least not bad.
Between capital and asset.
Isn't capital an asset? There's a question there.
It's equity, not assets.
It's equity. So equity is what? As a, it has a credit balance. Okay. Now, before I go into the adjustments, I want somebody to give me the format of our income statement. So we start with
So
sales.
maybe before you go there, Mr. Collins, could you kindly explain on the carriage inwards and the carriage outwards?
Okay, can somebody help? Carriage inwards and carriage outwards. Why are they both debited?
It's because they are both expenses, I think.
Yes, they're both expenses, except that one, it's an expense to purchasing. That's why we add it to the purchases. The other one is an expense to the sales and distribution. So what is carriage in? It's simply the cost of transportation. So if you're charging carriage in, you will go to buy stuff for a business and you use your own transport to go and buy maybe cement with 90 kwacha, then transport is 10 kwacha per bag. So meaning you're going to add the carriage to the bag so that you put it at 100 kwacha. It's a cost of transportation. Carriage outwards, if you're a company selling cement and you're selling it at what? 100 kwacha, but you're going to bear the cost of transportation. So of 10 kwacha per bag. So meaning that's still an expense that you're incurring. You charge it under the sales and distribution. Is that clear?
Clear.
All right.
What about trade payables?
Trade payables are also called creditors. They have a credit balance. Trade receivables are debtors. They have a debit balance. So debtors have a debit balance. Creditors have a credit balance. From the term DR, a debit. All right. Is that clear?
Yes, it is.
All right. Can we move? Gracious, are we together? Okay, so can somebody give me the format for the statement of the financial comprehensive statement. The statement of the comprehensive position or the income statement. So income statement, we have what? Sales
Sales,
less
cost of sales,
sales less sales returns
Sales returns, yeah.
less them. What we get whenever we're listing in accounts, we put brackets to negate them. And the figure we're getting is called what?
cost of sales,
Net sales.
net sales.
Okay, the turnover. Then we go to the cost of sales as the title. We're going to subtract our cost of sales from the sales turnover to get the gross profit. So we start with what? Our opening stock, opening inventory, which is found in the trial balance. So opening stock, purchases, add carriage. However you rearrange them, there's no strict order here.
Mm.
Then you can also list the what? Returns in the
Profit.
list purchases returns. And the figure that you're getting, you can list closing stock. Closing inventory. So when we list the closing stock, what we get is called our cost of sales. So the difference from the cost of sales, when you subtract it from our sales there, what do we get? When you subtract the cost of sales, we get
Gross profit. Gross profit.
good, the gross profit. So we have our, we subtract there, we get our gross profit. We can use, this is our gross profit. The gross profit, we can add other income. What other income can we add, if any? What other income can we add? Discount received. Or gains can be added there. If there's a discount received, you can add it there. If there's a reduction in bad debts, you can add it there. If there's any rent receivable, you can add it there to get our total gross profit. Then we can list what we call operation expenses. So these expenses can be subtracted. When we subtract our expenses from there, what we get is called the net profit. What expenses do we know? They are categorized into three main. The administrative expenses, which include salaries, which include wages, they include, I just want to generalize them, is financial expenses that we have, as selling and distribution expenses. These are the general types that we have, except that if you have, for instance, an administrative expense, if you are doing some workings and there's an accrual, what do? We subtract or we add an accrual. According to the accruals concept, whenever there's something that we haven't paid for, but we enjoyed the benefit, we need to add, because when subtracting, we need to add because we've already enjoyed the benefit. If your financial expenses that you prepaid, anything that you paid in advance, you less the prepayment because you have not yet enjoyed the benefit of that. Less. According to Afro's concept, sometimes when you have electricity bills and you pay them in advance, most of the people want to avoid what? Paying corporate tax, or paying the desired tax that is there. So when you add these expenses, you get the total expenses and you subtract them from the gross profit. What we get is the net profit before interest and tax. So this is how we do our gross profit, our net profit. Any questions at this point? Are we together? Are we following through?
Yes.
All right. Question. Which 2 or 3 items do we add to the gross profit, if any, in the trial balance? Which 2 items?
What, as in adding other income?
Yes, which other income items do you know?
Discount
We can add
received.
that discount received, and also a reduction in doubtful debt.
Yes. All right. So what else? Rent or receivable, if any.
Means what, Mr. Collins? What if there is you dispose of an asset and then you make a profit?
Yeah.
Is that other income?
Exactly, that is other income as well.
Mm.
Except that one is that undergraduate in complex. For you at masters, it's just basic accounting that you need to know. All right, so for the balance sheet now, you now need to fulfill the accounting equation. Who remembers the accounting equation?
Is it assets is equal to capital plus liabilities?
Okay, so we need to fulfill this. Current assets. So here we have what? Current assets. We have cost here. We have the depreciation, if any, and the net book value, if any. Okay. So under current assets, what examples of non-current assets do we know?
Property, plant and equipment.
Yes, property, plant and equipment, land. We have buildings.
Fixtures and fittings.
Okay, so in here, the cost value, you put it here. Land usually doesn't have depreciation. So this accumulated depreciation is treated as follows. If there's depreciation that you calculated for this year, you add it plus the one that was in the trial balance, you get the accumulated depreciation. That is what happens. So when you subtract it from the cost value, what we get is called the net book value. So collectively, the figure you get here is the total fixed assets, which we now call the non-current assets. Then we go to the current assets. Be careful to arrange the current assets in order of liquidity. Current assets are arranged according to the order of liquidity. Cash must be at the base here.
Mhm.
We go to the bank here. Then we go to the what? Debtors, or you go to the prepayment, debtors, and the inventory. If you have any, you put them there. So we have our inventory, our debtors, our prepayment, our cash and capital. Collectively, when you add them here, we get our total assets. So this is where we get our total assets. So we have this component here, total assets. Then we go to our, we have what we call the non-current liabilities and current liabilities. Okay, so current liabilities are short-term liabilities. What examples we have for short-term liabilities? Okay, we can have creditors. Within A, we have accruals that we can.
Who's explaining those things?
Are we moving together? Is this helpful, or we already know this?
It's very helpful.
Okay,
Very helpful.
so the creditors, the accruals or accrued expenses. We total them up. We also add the non-current liabilities. Non-current liabilities are long-term liabilities like a debenture or a long-term loan. These are succinctly stated. So when you add them there, you get the total what? Total liabilities. Total liabilities here. All right? So we can put your total liabilities here. So maybe this is your B and this is your A. We have a B here, A. Okay, so when you add them, they should be equal to our capital. So financed by capital, you can have it here. What? Net profit or loss, if any. What? Let's go. Okay, so when you this figure must be equal to A and B. This is how we call the balance sheet. So you can use any other format, because you know that if you want, you can say assets are equal to what? Capital minus liabilities. Using the accounting equation, it should still balance. If you want, you can rearrange them in whatever order you feel, but this must be fulfilled. All right. So please, let me emphasize on this part. So trial balance will be given to you, and additional information will be given. Now you need to know how to treat this additional information. To start with, you'll always be given closing stock as an adjustment, meaning what you have here is opening stock. Opening stock is always in the what? In the trial balance, and in the adjustments, closing stock. Are we together at that point? What can help you tell also are the dates. This is the previous year, stock 2019, 1st April. This is current year. Then adjustment number 2 is relating to expenses whose month was overlapping to April. So we're told that the insurance expenses that we have there included a 500 kwacha, which related to the month of April. Indirectly, they're telling you that this is a prepayment. So 500 kwacha is a prepayment. Now, you know how we treat prepayments using the accruals concept? Prepayments are subtracted in the comprehensive statement, but this is our money. They also need to reflect in our balance sheet under current assets. Are we together on this one before I proceed? Are we together on that one?
Please just say that again.
So we're told that
Repeat what you said.
included in the income insurance expenses was a 500, which was relating to the month of April 2020. But our accounting year is been given that it ends at 31st March 2020. So after March, which month comes in? March, April. So April is a prepayment. If they said maybe June, you could know intelligently that maybe the month 500 times 3, but the month that comes after March is April. So there's a 500 kwacha which was paid extra for a month. Our month was ending at 31st. So this 500 is a prepayment. So according to the accruals concept, prepayments, you do what? You subtract them, because we have not yet enjoyed the benefit of this insurance. But also we show it under our balance sheet as a current asset because it's our money. Is that clear now?
Yes.
Yes.
Right. So we go to another one. The company policy for depreciation is 10% on cost. Now this 10% has been calculated as depreciation. So there are two types of depreciation that you will need to expect. One is on cost, sometimes on reducing balance. Now every year there's depreciation that is calculated. So on cost is direct, just 10% of the amount that is available for the fittings and fixtures. So when you go to fittings and fixtures, this amount is 30,000. So 10% of 30,000 is what? 3,000. So 3,000 is the depreciation that we're going to charge this year in our income statement. But in the balance sheet, depreciation has accumulated because we've been adding all the years. So this accumulated depreciation you're seeing here is from the time we started. So it's currently moving at what? 10,000. But by the end of this year, we add a 3,000 so that the balance sheet will have 10,000 plus 3,000, which is what? 13,000. So this 3,000 is only for this year. Don't put the 10,000 in the income statement, but you put the 13,000 in the total balance sheet because this is now accumulated. What we put in the total balance sheet is the total figure there. Is that clear before I move? So we're using 10% on cost because directly you multiply by 10%. If they told you to calculate 10% on reducing balance, you first subtract 30 minus the 10 to get the net value of these fittings and fixtures, which is 20,000. Then that's when you calculate the 10%. This is when you see the word on reducing balance. But if it give you 10% directly on cost, just multiply 10% by 30,000. I think that is what I needed to explain, which is very important.
Mr. Collins,
Yes, madam.
so you're saying that if it was reducing balance, would have done 10% of the 30,000 kwacha, then which is 3,000, then deducted 3,000 from the 30,000?
No. On reducing balance, the 10% comes after we subtract 30,000 minus 10,000, the accumulated, the net book value of this fitting.
Oh, okay.
20,000, that's when you do the 10%, which is 2,000. That is if we're given.
On the 20,000.
Yes.
Okay. Oh.
Is that clear? Then we go to the other adjustment, which says a bad debt of 3,000 was included in the accounts receivables. And also this account receivable balance of 18,000 was a recoverable. So this 18,000 here included what? Bad debts of how much? 3,000. So our 3,000 will appear in the profit and loss account. So meaning now our debtors stands to be 18,000 minus 3,000, which is what? 18,000 minus 3,000 is 15,000. Okay, this is our new balance for the debtors figure. Then also we are told on 31st March, 250 was owing in respect to water bills. So what is this 250? It appears in two books. The comprehensive statement, it's an accrual. So all accruals, we need to add them because we have enjoyed this water. So you charge it to the comprehensive statement. However, this 250 should also be a current liability. Current liabilities are debts that are repayable within a year. So you need to show it in our balance sheet under current liabilities. Are we together? Then we are also told that there's a provision for bad and doubtful debts, which has increased by 900. If it reduced by 900, this 900 would have been added to the gross profit, but it has increased by 900. So meaning our doubtful debts was initially what? 5,000. So this 5,000, which we are subtracting here from the 15,000, we also subtract this 900 there, so that our debtors figure will ultimately be 15,000 minus 5,000, 10,000. 10,000 minus 900, we get 9,100. This is what will remain under the debtors figure. All right, so now we can go to preparing our comprehensive statement. So how do we start our trading account? What do we have there? So we have the workings that have been explained. So our closing stock is 8,000. Our insurance, we're told that there was a prepayment of what? 500, which was for April, remember? So meaning our actual insurance expense will be 1.5. After subtract 2,000 minus 500, we get 1.5. Then in the balance sheet, this 500 becomes current what? Asset. Then fittings and fixtures, we do 10% of the cost. So directly, it's like 10% of 30,000, it is 3,000. But there was another accumulated depreciation of 10,000. When we add them, this is the total depreciation which will go into the balance sheet of 13,000. And the bad debts written off 3,000. From the 18,000, this 3,000 will go in the profit and loss account. So meaning our debtors figure will be at 15,000. But that is not the only adjustment on the debtors figure. We also had another 5,000 there and another 9,000 there. So 5,900, when you deduct it there, we're going to get a total of 9,100, which will be our new debtors. We're also told that there are accrued expenses for water, which is 250. This one will be charged in the profit and loss account under expenses. And also,
Mr. Collins, where's the 3,000 kwacha coming from on account receivables?
this 3,000, the adjustment.
Oh, the bad debt written off. Okay.
Yes. Have I lost anyone so far before I proceed?
On total depreciation. So the 10,000 plus the 3,000 is the depreciation for that reporting, eh?
Yes, from the time we started depreciating up until now, this is now 13,000. But what we're charging for now only in the profit and loss account is just a 3,000. This is what goes to the balance sheet to calculate how much asset we're remaining. So 10,000 could have been for 3 or 4 years back, together with what we have today.
Okay.
Is that clear? Can we proceed? Then we can now start doing the income statements and the comprehensive statement. So our sales is 93,600. Of course, I don't necessarily have to prove, but these are the figures that are coming from what? This balance sheet here, the sales figures, 93,600. If there's any returns, we bring it up. So this is according to, just understand the format we're talking about. Then here we have this cost of sales. So here we have our opening stock, we add purchases there. There were no returns or no carriage inwards. You put it there with this closing stock, which is 8,000. Then the figure we have there is what we call the cost of sales. When we subtract the cost of sales from our sales figure, what we get is our gross profit. And this was a reduction in bad debts, or those items we spoke about would have added them there. So this is how we get the gross profit. Are we clear so far on the gross profit? Anyone behind before I proceed? Okay, then we go to the operating expenses. Insurance was 2,000. Remember, we subtracted the what? 500, which was prepaid. That's how we're getting there. Our 1.5. Office expenses, 18,000. The bad debts, the 3,000 was extracted from the what? 18,000 for the debtors. Water expenses is the accrual. This will also need to appear in the balance sheet. Then salaries, 225,000. Increase in provision is 900. Now, I will need to explain something quickly, which is very important. That was simplified. So provision for doubtful debts is usually based on the debtor's figure. So suppose you're giving a percentage, you say 10% of the debtors will default. So this is a provision. A provision is made in accounting to a certain number who may not pay up. So 10% of our 100,000 is 10,000. Now, in the case that you had deducted the doubtful debts provision, you had actually estimated that 12,000 would be what? Would be the default. So already 10% of 100,000 is 10,000. But what we had charged was what? Was 12,000. So what we have actually incurred is 10,000. So there's 2,000 kwacha here that we overcharged. This is called a reduction in doubtful debts. So this is the 2,000 that you are going to add to the gross profit if you're using percentages. However, if 10% is what you estimated, and actually you actually charged 7,000. So 10,000 is what you expected to lose out, but actually the actual was what? I'm now confusing you. 10,000 is what you expected to lose, but here you've actually lost 12,000. So there's a 2,000, which is an increase in doubtful debts. So this one is an expense. If 10% was what you provided for, and you actually lost 7,000. So meaning there's a reduction of 3,000. This reduction is what we are going to add on to the what? The gross profit. But there were no such deductions. He just gave you direct, which say there's an increase in the provision by 700.
So that's the one we add as other income.
Yes, that's the one we add as other income if it's a reduction. However, if you forget to do that, you can just put it in the expenses as a reduction in that for debts, but you subtract it amongst expenses. It's the only negated expense that you can put there. It's still acceptable. Is that clear?
Yes.
So this increase in that for debts 900, then the depreciation on fittings and fixtures was what? 10% of our 30,000. This is how we got the 3,000 here. And the total expenses, when you total up here, we get 48,650. You put them in brackets here. So when you're getting these expenses from the gross profit, unfortunately, we had more expenses than the gross profit. So this is our net loss, which is 22,050. So this opens you up to acknowledging that we do not always expect to make a profit, sometimes expect losses. So this is how we get our net loss. Any questions at this point? Are we moving together?
Yes, we are.
Right. So which book do we go next to from here?
The balance sheet.
All right, the balance sheet. So in the balance sheet, we also call this statement of the financial position. So we only had one fixed asset. Fixed assets are also called what? The non-current assets. Okay. So we have our fixed assets, which are 30,000. Then our depreciation is 13,000. Wait a minute. Our book was showing 10,000. Where's the 13,000 coming from? Can somebody remember?
So it's coming from the 10% of the depreciation of a 10% of 30,000.
Okay. Then
So which we got the 3,000.
all right. If you go to 3,000, correct. Okay. Do we agree with that?
Yes.
So this is where 17,000 speculated because it's the net book value. Then we go to the stock. Remember, we have cash at hand, 400 at bank, prepayments, 500. And we have our debtors. Our debtors, we negated 18 minus 3,000 minus 5,9. Remember where these calculations were coming from to get 91. And our stock is 8,000. So when you total this up, we get 19,200. So 19,200, we can either add it to this fixed assets or we just subtract our current liabilities there. So we have our creditors, 13,000, the water expenses. When we subtract them, we add them here. This is 13,250. So when we subtract it from there, we get 59,50. This is called the working capital. When we subtract the working capital from our total fixed assets, we get the capital employed, which is 22,950. We less a long-term loan, which we had for 15,000 to get our closing capital. So we want to connect this to our capital here. Financed by share capital is 30,000. We less or we add the net profit. So since we have a loss here, we subtract it. If there are any drawings, we can less as well. But since we're not drawings, we just subtract this and that, we get 7,950. So this tallies with what? This, so it has balanced. All right. So are we together so far? So this is how we had to balance up this. So this is where question 1 ended. With this said, I'll need you to try the question from the pamphlet. This is question number 10 on bedrock. The adjustments are all here. Okay, then you prepare our 2 books.